Today we're talking to Dean Fergie from Cyan Investment Management. We're going to ask Dean how he's handled the extreme volatility of the last couple of months, with the market falling dramatically until March the 23rd and then bouncing quite dramatically as well. Under these volatile conditions, managing money is certainly not easy. Let's see how Dean handles it.
I think everyone has been caught by the speed at which it all happened and the major impact that has both on sort of the society level but also the marketplace. We saw the market, have one of its fastest crashes in living memory, I think, and it's also had one of the fastest rebounds over the last couple of weeks as well. So it's been very difficult managing both the day-to-day volatility and also the intraday volatility that's been extreme. And I think you've really got to kind of put a bit of that aside as a longer-term investor. Sort of be aware of the companies that might be struggling in their current environment and then trying to put money into those you think are going to benefit.
So, Dean, how would you expect quality companies to perform in this environment?
Yeah, it's an interesting term, quality. I mean, I guess you would have seen companies in property, entertainment, tourism. I don't think anyone would say that Qantas is a highly geared junk company. If some of these property trusts, Centre and the like, are poor quality. But you've seen, some of the worst returns I've seen in the last month have been from sort of property income funds that are down 30-40%. I think it's just been mind-boggling, the fact that you just don't see aeroplanes in the sky, that you don't see shopping centres. So people's mindset in terms of quality has had to change really quickly. Whole sectors that have been completely decimated. Ticketing, entertainment, any of those businesses are basically their revenues are pretty much gone to zero. So it doesn't matter if they've been previously well managed, they're lowly geared, they're all in trouble because revenues have gone from being their whole business to almost nothing.
So in this environment, Dean, to what extent are you adjusting the portfolio?
So it's been interesting. I think there's one element that it's certainly not the environment to say, oh, look, everything's fine, let's just stick with what we've got and run through the long term. We owned some shares in Webjet at the start of March, and we sold out of those pretty quickly when we saw this unfolding. We don't really own anything in the property or the sort of apparel retail sector, but I think that the clouds on the horizon for those businesses have not cleared yet. If you've got any sort of debt, I still think you're guessing in terms of, she'll be right. Personally, we've been really surprised about the strength in Qantas and Flight Centre and corporate travel and the like. We think those businesses are in for a really, really tough time, and they may not in the medium term get back to where they were. So any of those businesses that looked really, really at risk, we got out of completely. But then there were some we pivoted in, some more of the telecommunication businesses, some software businesses that looked like they were going to not be too affected or indeed potentially have a tailwind from the current crisis, and that's where we've sort of pivoted our portfolio. It's just not the time to be going, it's a set and forget portfolio because the world has completely changed.
How long do you expect before things are back to normal?
Obviously, the market's very forward-looking, and I think most people have written off certainly calendar 2020 from an earnings perspective, and the market at the last 3 weeks has sort of looked past that and really bought into a lot of the stocks that have been previously really, really slammed. I think our issue is that whilst the medical numbers might be improving, there's really no rhetoric from the government to say, hey, we'll be back to normal anytime soon. I think there's still talk that there'll be pretty major restrictions, for the next 4 to 6 weeks, and then maybe slowly opening up of more retail and hospitality sort of networks. But I think it won't be this year before people are able to freely travel internationally, before they'll be able to go to nightclubs or concerts or large sporting events. I think I think the market's being overly optimistic about everything being back to normal in the near term. So wouldn't call it a suckers rally at the moment, but there's still large sectors of the economy that we think are in for a very, very sluggish return to prior profitability.
So, do you see this as a buying opportunity?
No, I don't think so. I don't look at just levels of the market and say, wow, it was a lot lower than it was back in January. This is a great buying opportunity. You've got to bring that back towards earnings and I suppose, sort of economic growth, and that's changed. So the market's quite rightly changed. I also probably overall, and again, we don't look at an overall market. We try and cherry pick the best opportunities in the market. I don't think overall it's a great buying opportunity. I still see real problems with credit defaults. I see that flowing through to the banking sector. The government isn't going to be able to bail out every business that's struggling forever. So I think that flowing through the economy is going to be quite sustained for quite some time. So, of course, as I said, there will be opportunities in the market where there's good buying opportunities, but overall, I still think there's some challenges and tailwinds ahead for a few months yet.
Dean, as always, thank you very much for your time. Do you have any final comments you'd like to leave us with?
It's been remarkably challenged, but also as an investment fan, it's incredibly interesting period to go through as well. I think you just have to pretty much sit tight, look at your portfolio, go, where are my risks, eliminate those, and any of the bright spots, concentrate on those. So good luck to everyone out there.